Is anyone buying stocks anymore now that interest rates are high? Seems like everyone is content holding cash in high-yield savings or T-bills because of the 4-5 risk-free return. Is it not a good idea to be buying stocks or index funds? People say they may be holding the cash to buy stocks, but is the move to buy stocks with the cash on hand when interest rates are being cut? Is it possible that this decade stocks index funds will not perform and T-bills cash outperform? What happened last time this happened in history? More people that exit into cash should mean more deals to buy stocks as they fall. Maxing 401k. Holding cash. Be greedy when people are fearful. I'm still buying index funds. I DCA into VT Sachs every month. Just picked up a second job to buy more VT Sachs while it's down. So many different answers. It's like we are all guessing. Never stopped buying index funds. Can't wait for all that money to come rolling out of bonds and back to stocks. Yes. In my retirement accounts, I have a good amount of cash, and the last allocation I did back in August was about 50 bonds. In my taxable account, though, I'm all in stocks. I just don't see the appeal of a 5 return on a relatively small amount if it's going to be taxed. Anyway, in terms of my whole net worth, though, I am probably 30 in bonds right now, which is higher than I've ever been. Maxing out all my retirement accounts, including Mega Backdoor Roth. I'm young, I got time. I'm watching my portfolio crash but buying as it's doing so. Stocks are on a huge sale right now. 5 interest rate is just a facade. If you're young, you should be overweight equities. I don't want to see people my age hurt themselves by going into fixed income. Equities are still beating the hell out of bonds YTD. Red dot sale all week, red circle. Now is best time to DCA. Actually, all time is best for DCA. I am still doing $1,500 a week into funds ETFs. Yes, I buy every 2 weeks. I'm still down from my ATH in January 2023 overall, but I'm up almost 16 for the year. Now 17 cash overall in SPACs. Acquites keep slipping and I have a shopping list, but it's hard to give up that guaranteed 5.13 for volatility, especially with what is going on in the world right now. That being said, I've been nibbling at my long-term positions, buying small amounts on dips, hoping they don't dip further. As others have said, good luck on the timing. Tables are open. If you've got the financial stability for it, and you're looking to own stock assets for the long run, just consider the market downturn a sale on those stocks, albeit a sale that may last a while. Get cheaper after you own the stocks. But what do you care if you're going to own them for their long-term return? That's a lot of questions that cannot be answered. 5 guaranteed return is nice, but pales in comparison to stock market returns. This year, even after the correction, the Nasdaq 100 is up over 30, and semiconductors over 40. In the long run, nothing beats stocks. I buy about $750 each month in a handful of individual stocks. In addition to my Roth investments, I've always done it this way. The economy ups downs does not matter. In theory, investors will still demand the same rate of return for risk. If the stock market doesn't return the risk premium for a long enough period, stock prices should drop, creating an inverse in demand, crashing the market. In response, rates would most likely be lowered, or we enter another depression. More than likely, in reality, the market remains strong and stock prices continue to trend up, as that is what happens 90% of the time no matter what is going on. I'm shorting stocks because of the flight to T-bills. Bit of column A. Bit of column B. Had a large cash sum from house sale. Have been drip feeding it into stock. While the cash chills in USFR. Selling 80 delta puts on the margin from USFR. Working it so far. It's to a point when the put sale wins directly pay for the DCAing into the stocks. Granted, I'll eat major shit if stocks crash. But it would be the same if I went all in stocks. Just without the premium gains. Disclaimer: I have no idea what I'm doing. But I'm okay with it. It's keeping me from wanting to invest more than my DCA. Like I used to get a bonus at work or money left over for the month and invest it. But now I leave it in savings. I invest mainly into mutual funds by using automatic investments every week. I haven't stopped that because interest rates are high. And don't plan to no matter what interest rates do from here. Every week. Also did a quarterly deposit. You have a warehouse full of quality companies trading 40 off. Tons of people in cash, so of course I am buying. I love deals. Those 5 yields could evaporate overnight. Better to buy assets with a higher long-term return if you have the time to wait it out. I'm buying things I like now while yields are 3-4 and prices at the lower end. Then sell if I choose when they go back up 20-30 in a few years. That theoretically will outpace holding cash. I only buy value stocks with low PE, stable cash flow and from defensive sectors. Bond funds have been hammered. I'm putting more money into bonds currently, but not going to make any rash decisions to sell my existing stock. I'm something like 90 equities, 10 fixed income. And I'd rather have it be closer to 80-20 or 70-30. I don't see how now specifically is such a perfect time to buy stocks cheap. Though, other than it always being a perfect time to buy stocks if you DCA, of course. SP 500 is up about 12.5 over 1 year. 22 over 3 years. 59 over 5 years. Or 142 over 10 years. Seems to me like the stock market is up overall and not crashing. Buy stocks that offer a similar return via dividend and hope they don't have to cut it, haha. I've been buying Pfizer little by little as it drops. It's over 5 div now. Always be buying. Adding to 401k. At this point better to park the cash in a high interest account. Everyone here will say you can't time the market, and it's true, it is hard. Like in January no one thought tech would have a monster year. One thing that does work pretty well is to be cautious when SPY trades under the 200-day moving average. This is when bad things tend to happen. I'm not selling my retirement account cause it's a DCA strategy, but I also don't mind spending 1 or so on put options as a hedge. If I'm wrong it's NBD since my account has averaged 10 a year, and if I'm right it's like having home insurance when your house burns down. Just my 2 cents. Guaranteed 5 average 10 long term. Cash is closer to 5.56, IG bonds closer to 6.57, high closer to 10.511. Equities expected return is like 6 right now over the next year. Yeah, why take the risk when you could achieve the same expected outcome? The market will drop hard if and when the rates start to drop. This has happened historically. Some people are waiting on the sidelines. Also, the Magnificent Seven is what's propping up the SP 500.